Till now, we looked into two-stage dividend discount model in which we introduced our steps. First, we look into what is the expected dividend. Then, the present value of the stock. This is through the Gordon growth model. After that, summing the dividend and the stock value in that year. Thereafter, discounting to arrive at present value of all the future cash flows to the present, and the sum of all these present values of the future cash flows would be the stock price expectation. Let us work on a three-stage modeling problem. Although the process would remain very much same as we have done in two-states modeling, but just to give you a different perspective on a three-stage modeling, I just thought of doing this question with you. We have a company which has a current dividend of $1 as D0. We have rate of return as 12%. We have a supernormal growth rate as 15%. So we call it SG. It is there for next 2 years. Then we have the middle. Let us call this as IGG. This is for next 4 years. It's given 10%, and our terminal value growth rate is given as 4%. We need to calculate current value of Ross and Company. The first step is to find dividends. We need to work in parts. First is 15%, then 10% and 4%. So the first growth is for 2 years, then for 4 years. So basically till 7th year we need to create this. The dividend in the first year is given as 1. Calculating for the next year. We take previous year's dividend. We multiplied by 1 plus the supernormal growth rate. It will be applied for 2 years. So, we get 1.15, and then the second year as well, the same growth rate, and after that we are given that for the next 4 years it will grow at 10%. Applying 10% growth from 2 years after. Drag the formula for the next 4 years. At last, in perpetuity it grows at 4%. Then, as a next step, we have to find out is the present value through Gordon growth model, which is PV of future dividends, in perpetuity, that is the next year dividend divided by R minus G. With terminal value growth rate, this gives us $25. In the next step, we are going to find out the cash flows by adding the last year's stock price to its dividend. Then, in the end, we will find out present value of cash flows. To find out the discount factor, it is 1 divided by 1 plus the rate of return raised to the power 1 when we are in year 1. We get 0.894 as a discounting factor, and we drag the formula till 6th year. Now the present value is simply to multiply cash flow with the discount factor. Then, when we add all of these present values, we get our value of Ross and Company. This is the stock value. We got 18.87. The only difference between the earlier example and this is that here we have 3 rates. One is a supernormal growth rate, the other is intermediate growth rate, and the last one is a terminal value growth rate. So, we are applying 1 step extra for the middle part. Rest is same. We are applying the same terminal value formula and applying all the same steps except the first step where we calculate the dividend. In that step, there are 3 rates instead of 2 growth rates. Rest of the steps will remain same, and accordingly we will move on to the step 2, which is terminal value, and then step 3 would be adding terminal value and dividend. So here we get cash flow, and then we discount all these cash flows to arrive at present value of cash flows, and the stock value is sum of all these present value of cash flows. With this we complete our section on dividend discount model.